I think that the case is definitely building there. And I think what's important for investors to keep in mind is that inflation's coming off, and this is sufficient for the Fed to start dialing back the amount of policy restraint it has delivered to the economy. Right. It's not cutting because the economy is weakening. It's recalibrating the amount of restraint needed because the supply side's doing some of the work for the Fed.
The powerhouse that Mr. Cohen's put together at Point72 with Dean Mackey's Stanford economics, Sophia Drossos' Michigan economics is like, it's world class. And the overlay of those two schools is don't forget fiscal. Are we forgetting our debt and deficit right now?
I don't think we're forgetting our debt and deficit. I just think that there's probably less clarity at this particular juncture. It's certainly something that people are discussing. And when we get these budget forecasts that the fiscal deficit is going to be 7% of GDP.
Should our listeners and viewers be worried about that?
Yeah, it is a pretty eye-popping number. I don't think, though, it has fully shown up into price action. And in particular, I see that in the dollar, which remains very elevated despite some of these fiscal risks that are percolating.
So a lot of folks will say that the Fed's already behind the curve, that they should be cutting rates already. Are you concerned that the Fed is, in fact, behind the curve and that is increasing a recession-type risk, maybe in 25?
So I don't have the same urgency that some of these other commentators might, because this is a very different cycle. I would argue you could say the Fed's behind the curve if we're seeing the economy start to weaken materially, and that's not where we are at all. And I think this week what we'll see is that GDP will accelerate a bit from the pace that we saw in the first quarter. Consumer remains strong, and all the recent data points, again, show some pickup in momentum, which I think is going to last into the balance of the year.